is true, and this is based on the latest earnings season combined with a probably or likely decline in interest rates. The earnings season was good, 60% of beat ratio for all the companies, centered mostly in the large tech companies, because if you look at the year-over-year basis in terms of growth rate for earnings, if you remove the large tech companies, actually earnings are down a little bit from last year. So I think it's a combination of, number one, the investors being reassured thanks to the strong earnings, but second and most important, direction of travel in terms of interest rates. And as we have heard, 1 or 2 months afterwards, we should be having the first rate cuts originated by the Fed.
Indeed, though, and I know the house view is that the Fed's room to maneuver is narrowing. It was Caesar over on your team who recently warned that financial markets might be operating in Wonderland here. So I'm wondering if you can unpack the house view and explain to me what Wonderland actually looks like and where we could be going from here.
Of course. The Wonderland is a combined existence of rates which are staying high for longer, and at the same time the S&P 500 hitting new highs, as we have seen at the Dow Jones overcoming the 40,000 magical level, if you wish. One of the two of the issues will have to give. And the question is, how long can we continue to have the market being where it is with rates where they are? Because let's face it, for small and mid-sized companies, the longer rates stay at the current level, the higher the pressure on their financial situation. Because opposite to the large companies of the S&P 500, small and mid-sized companies need to come back to the market to refinance because their average maturity is much shorter. So if the Fed is not in the position to cut rates quickly, then the financial pressure on those companies is going to increase, and hence the Wonderland in which we are may become less fancy as we get into a high rates situation.